What is up, everybody? I hope you had a spectacular weekend and that you're about to have an even more spectacular week. Welcome to the Monday Market Update. My name is Sean Grapevine. I am a co-branch manager of the Atlanta UMortgage branch here in Atlanta, if you couldn't tell. I am joined today by the man, the myth, the legend. When the yield curve is inverted, he's completely upright. He once found 37 basis points on the sidewalk while on vacation in the Maldives and overnighted them to me via private jet courier so I could apply them to a VA loan to win a deal from the #1 real estate agent in the world. He's the Sultan of Secondary, the Mac of the rate stack, the taste tester of each investor. He's the Baron of Bips, the Titan of the 10-year, the recipient of a crowd-funded nickname campaign. It is the awesome Austin Koenig.
Sean,
Welcome,
thanks for turning me into a Paul Bunyan of secondary markets over here.
You really are.
It's becoming folklore. I don't even know. I've never been to the Maldives.
I don't even know where they are. I think they're near India.
All I know is it looks really cool. But no, thanks again for the intro and joining us. Taking the time to do it. Pretty big week last week we had, right?
Yeah, you have to be sleeping under a rock to not have experienced some level of excitement last week. Why don't you tell us about it?
Yep. So I think last week on the Monday market update, I predicted a disappointment with inflation. Thankfully, I can be wrong.
We don't have to. You don't have to rehash that. I was going to ignore it.
Yeah.
I'm just going to skip right over
it. Well, I will say, at least we got some good news where inflation did beat expectations. Just to kind of put this into perspective, we had a 7.7% CPI print, which was lower than the 7.9 we expected. But the key thing here is, like last month, we saw an 8.2% print. And this is the first time we've had anything in the sevens since at the beginning of the year, really, which is, obviously a good sign. Inflation's kind of ticking down. And at the end of the day, this is a kind of a big reaction, and the market didn't have a chance to digest it any more on Friday with Veterans Day occurring and the market being closed. So today we're going to kind of see how the market digests that with a lot of Federal Reserve perspectives coming out. So a lot, one thing I shared on the Capital Markets Q&A was a lot of things kind of recapping the inflation print and kind of how to look into the numbers a little bit deeper. Definitely encourage you guys to take a look at that. But to kind of save a lot of time and effort into rehashing all that stuff, at the end of the day, there's a lot of things in inflation that can even kind of continue to improve, and these are things that the Fed are targeting, which such as rent, for example, that is still kind of sticky high right now. We can see that possibly go down lower as we get time going by, but at the end of the day, we have a lot of Federal Reserve members speaking this week. That's a key thing to look out for, because what the market did on Thursday of the last week was they try to price in this data point and think, okay, well, how is the Fed going to react? And we think the Fed's going to react by, cutting down the, the amount of hikes that they might be doing this upcoming meeting in mid-December, and how they kind of approach next year. And is it working? Do they need to kind of sit and pause for a little bit and see how it continues to go down? But the Federal Reserve, I'm sure, will probably saying things along the lines of, no, we're not going to stop quite yet. Great, but we have a lot of work to do still. Because at the end of the day, I think 2%, that's their inflation target. We're not close to that. Unemployment rate, they want it at 5%. It still has a lot of healthy margin to go up from where it's at right now. So I think it's kind of like a battle between two forces here, and the market wants, the Fed to pivot. The Fed kind of has still a lot of ammo to say, no, we're not going to pivot quite yet. So we'll see what happens.
Sure. Yeah. So I remember, back when they were trying to do quantitative easing and lowering interest rates, like there's a hard limit on how low you can go on interest rates. Sort of. I mean, some European countries went negative, essentially charging lenders to central banks for lending them money for a safe haven. But there's literally there's no limit to how high you can go, right? Like they could just there's no hard limit. So they definitely still seem like they have a lot of arrows in their quiver. What do you think? Like, to maintain the current optimism around inflation, right? Like a 0.5% drop in 1 month is pretty huge, and that's what we experienced this month. Are we going to have to see 7.2 on the next print in order to maintain the same level of optimism?
Yeah, actually, I think we probably need to see something, pretty significant. One leading firm in the fixed income space is PIMCO, and I was watching one of their heads of economic, strategy and everything like that this morning, and he was saying that they are thinking 7.3 is where we end at this year. At the end of the day, though, 7.3 is still high. Think about it, kind of a vacuum here. A CPI is a year-over-year reading, the one that you see that gets kind of on the
Mhm.
headlines, right? The
Mhm.
one we're talking about, 7.7, that's a year-over-year. So when we're kind of talking about next year, we're going to be referencing 2022 prices at the beginning of 2022, of course, and how that's going to compare. So at the end of the day, we should see inflation tick down at a fairly decent clip over the next year, especially because at the end of the day, prices are not going down per se, but they're not going up that much more.
Right, right. We'll
And
start losing some of the months that had like the insane inflation in them as we progress
correct.
through next year, basically.
Yeah, I think that's what we're going to see. And with that being said, too, is how can we actually get some price recovery possibly in some aspects, and just along the lines of we have to continue to monitor the data points that the Fed has been harping on.
Mhm.
I think in terms of data points that we even see this upcoming week, the main one that I think is fairly important is PPI. So PPI is a kind of a lesser paid attention to inflation reading. It's about what the producers of goods. So like think how much does Walmart have to pay to get all this stuff so they can
Mhm.
sell you things at prices, right? So it's kind of like how does those, you know, I guess businesses pay for the amount of supplies that they need and all that sort of stuff. So
Mhm.
what are they passing out to consumers? If they are also seeing less inflation, like on their side, then we should be in a fairly good standpoint. The market will probably like that. But who knows what that's going to actually look like at the end of the day. So
Sure, sure. And I've seen a lot of reports of like not only are the Fed raising the interest rate, is that driving down uh prices and inflation domestically. I also read a Wall Street Journal article this morning that said, there's shipping containers that are sitting empty in Chinese ports rather than like what we dealt with for the last 2 years, which was an insane, like you just couldn't even get goods shipped to the United States. Shipping containers were costing 3 times as much to ship because there was such a shortage of them. And now we've
mhm.
kind of finally hit like the old status quo, which is like there's always enough containers to rent or buy or however it works, to put your goods in and move overseas. And we're also seeing the chip shortage is finally sorting itself out, right? Like if you're in electronics or automotive or in any sort of manufacturing, the silicon chip shortage has like crazily affected pricing. I play video games, and in the middle of last year, Nvidia put out the GTX 3090, as we all know, um,
Oh
and
yes.
uh, and it was the first ever graphics card to retail at like $3,900, and they were basically like it would be cheaper, but it costs half the cost is just getting a chip. So it sounds like we have some structural alleviation to some of the inflation that like Fed interest rates aren't affecting any of that stuff, but it seems to be kind of recovering in lockstep with prices here domestically. Is any of that right?
No, no, no. I mean, anecdotal or not, that's actually exactly correct, though. I mean, and think about it like this too. Um, you know, Supply and demand is it's a give and take sort of relationship, right? And the thing is, the Fed can't control the supply side very well, but the
Hmm.
thing that helps supply gets feet back under it is curbing demand, and that's what interest rates and kind of the swap of quantitative easing versus tightening, and there's no more free money anymore. You're seeing things be more expensive to finance and everything like that. So if for example, if you don't have a zero, like a really cheap loan you can take out to buy a GTX 390 or whatever that you're $3,900 where you just got $1,200 from the government, to pay for that
Sure.
thing. It's a lot more of a decision you have to make, and maybe not as many people are going to buy that, for example, right? You're seeing this in the car market as well, like where you saw automotive, you know, cars were so hard to buy you couldn't even buy a new one. You'd have to just kind of buy whatever is there, and the used cars prices were going through the roof. Used car prices are definitely coming quite down quite a bit actually, and that's actually helping the inflation side of things too. That'll continue to normalize here over this next year. Financing a car is not going to be cheap anymore. At the end of the day, there's a lot of things that help with the supply side, because maybe that instead of being able to afford a Mercedes at the rate you're able to qualify for, maybe you're only sticking at the Hyundai or Kia dealership, instead of when you can literally buy a Mercedes or a Hyundai, based off your affordability of your income and your DTI and everything like that. So at the end of the day, it's definitely a more normal market, and it allows things to kind of recover a little bit better, and people are not overextended and everything like that. So at the end of the day, it's just curbing demand, and that's what the Fed's trying to do. It's trying to help supply, but things such as global crises and wars, that they can't solve that, but they can help solve the demand picture of the world economy.
Sure, sure. Yeah, that makes total sense. What do you see as far as housing? So, what is the effect of raising? I mean, we know what the effect of rising rates are on our personal pipeline. What do you see, more broadly in the market? Do you think that housing prices, like appreciation, is going to slow, flatline, decline? Are you worried at all about it? Where are you at with like the housing market values?
The housing market values is going to be an interesting one to keep an eye on. I think we do get some data on housing over the next week or so, and the thing here is that we'll be really like paying attention to, especially as a loan origination platform, is what the conforming loan limit is that gets released at I think the end of the month is November 29th, I believe, is the date it gets released. I remember when like I think PennyMac, Rocket, UWM, they all came out with 715. 715 doesn't really exist anymore, by the way. Everyone's kind of adjusting down to about 700 level. So I think if you go to UWM, for example, right now and price a 715 loan, you're going to see 1.875 as an adjuster on there. Just to do the math real quick on that, guys, a 1.875 point adjustment on a $715,000 loan is over 13K. So think about it like that.
They're
You're
just
paying
making it all up in
13K.
fee. Yeah.
Exactly. You're paying 13K for 15K. That's not a very good return for your borrower. You should not be selling a 715 loan to them at any point. It's just dollar for dollar. It doesn't make any sense. So the 700K is probably what we get. The house price, kind of trend that we're seeing is obviously going down, but that's actually kind of where we need to be too, is maybe some corrections. We saw some markets get super red hot. Those are probably the markets with the most weakness that can occur, over the next, couple months or year. But at the end of the day, you can look at the charts, but the average, dollar value of house you're going to be able to qualify for right now is much lower than it was when rates are in the threes. And that's just, at the end of the day, what needs to happen to kind of cool the housing market. The supply side of things, though, I don't think is really recovering. There's still going to be low supply. Think about it like this: if you're a borrower, or you're looking to buy a house, and you have a house right now that is, financed at like 3%, there's got to be a really good reason for you to actually need to change houses or put your
Sure.
house up on the market.
Yeah. Not to mention, if you bought a $550,000 house at 2.75% in 2020, and you want to buy a new house right now, you have to stomach, essentially, to replace your house and improve on it, you got to buy a $1 million house at a 6.5% interest rate. I think it is going to be tough, and I think it's going to be really tough for those top market, $500,000+ loan amounts. I think the loan officers we're seeing have the most success, like Ben Bell, my co-branch manager, are the folks that are working with first-time home buyers, everyday Americans, like blue collar borrowers who weren't able to buy for the last 2 years, and now who like are finally able to attain the American dream because their incomes went up, their debt was retired, like they have less household debt. They're probably making, if they were making $30,000 in 2019, they're probably making $60,000 now. And if their spouse also is, right, they've got a 6-figure income, They've never owned a house before. They retired a bunch of their household debt, and they're finally ready to buy. And to them, right, like, you don't, if it's your first house, you don't care what your interest rate is. 6.5%, that's fine. I can afford the $2,100 a month payment. It's more than I'm paying, or it's less than I'm paying in rent anyway. And I get to own a home and develop equity in my house, and ride up any market appreciation over the next 5 or 10 years or whatever. I think that this the workings of the housing market right now are going to kind of cordon off that $500 to $1 million range, and it's really going to favor these first-time homebuyers who can finally get down payment assistance, who can close a loan with FHA or VA, who can take 25 days to close a loan instead of 12 days, right? Who aren't competing against a ton of hedge fund cash offers that want to close in 8 days without any due diligence. I think it's actually really healthy for your everyday American, but it is requiring some of us to pivot from you're not going to get a bunch of 780 borrowers buying $800,000 houses right now if they already own a house. It's just not in their best interest to even think about it. They'd rather renovate than move.
Exactly right, and that's 100% the case that I think we're dealing with, and that's the Fed does not really care about the person who bought a $900,000 house last
Sure.
year and hoping they want to flip it for $1 million this year. And that's
Right.
obviously not going to happen. And they don't care about that. That's what the FHFA is there for, is they want to help the first-time home buyer. And that's exactly the clientele, we want to be, making sure it actually does get properly serviced here in this market. And there's still, really great opportunities for first-time home buyers in this market. In fact, it's probably better for them to be operating in a more buyer's market arena than seller's market, where they can actually, feel comfortable about the deal instead of just kind of saying you have to submit this, above ask offer to be even considered for, this house. So it's much more of, I think, a approachable arena for these borrowers, even though they have a higher rate than maybe what they've seen in the news in the past year or so. At the end of the day, rates will not, stick here in the long term. It's a kind of a temporary pain that they'll have to deal with, and there's probably going to be an opportunity to refi in the next, couple of years, and they'll be, even better for it. And that just continues this story about wealth building, and they can build up the equity along the way.
All right. So last thing before we go, we have seen some LLPAs dropped around some affordable products recently. At Home Ready and Home Possible have dropped all LLPAs. Is that right?
Correct. So I think that there's that. We used to have that limit there. We're kind of dropping all LLPAs in that instance. And you think about it like this: these are going to be continued, efforts by the FHFA. I think this is just the start, to be honest with you.
Sure.
These affordable products are going to continue to get better for, use, and that's what they want to happen. And this actually, if anything, means don't count on investor or second home LLPAs to get better anytime soon. That's exactly the stuff that pays for this kind of affordable
Sure.
housing initiatives. And maybe there's maybe some risk factors to issuing these things, but they're going to pay for that with the second home and investment LLPAs that they have. That might not seem super fair to those borrowers, but that's not what the agencies are there for. Is for making the rich get richer. So at the end of the day, I think this is a great move for them. We'll hopefully continue to see more, and see more about how affordable products continue to expand and are continue a great option for these borrowers that need it. And I think there will be a lot more, I think, announcements, especially as we kind of get the updated income, medians and all that good stuff. And it might just even be a more useful use case for your borrowers, because obviously that median income is a trailing median income, and we just need an update as well on that too.
Yeah, 100%. So go out there and lock some condo deals for your Home Ready and Home Possible peeps. It's gonna be a great deal. So all right, well, this is great. Thank you so much for your time this morning, Austin. I know you probably got about 50 locks to get locked with the team over the past 20 minutes. So we'll let you go and do that. Appreciate your time. Thanks everybody for joining, and we will see you next week.
Sounds good. Thanks, Sean. See ya.